Even top-tier U.S. consumers are feeling the pinch as 90-day delinquencies soar. The financial health of even the most credit-worthy U.S. consumers is under strain, as evidenced by a significant rise in 90-day delinquencies. According to a recent VantageScore report released on August 25, 2025, delinquencies among superprime borrowers have surged by 109%, while those among prime borrowers have risen by 47%. Consumers in the highest VantageScore credit tiers are showing increased signs of credit stress on a year-over-year basis, stated Susan Fahey, Executive Vice President and Chief Digital Officer at VantageScore. This uptick in delinquencies is particularly concerning because it indicates that even the most financially stable individuals are struggling to meet their obligations. But here's where it gets controversial. Some experts argue that this trend might be a harbinger of broader economic issues, while others believe it's a temporary blip caused by specific market conditions. Mortgage and auto loans are leading the charge in terms of delinquency rates, with mortgages seeing a 0.11-point increase and auto loans a 0.05-point increase. The report also notes that both auto loan and mortgage balances have risen on a month-over-month basis. While mortgage originations have remained relatively stable, auto loan originations have seen a decline. Auto loan originations dropped to 1.42% in July, down from a peak of 1.76% in April. Mortgage originations stayed flat from June to July, but were still 0.04% higher than in July 2024. The report suggests that these softening trends could be attributed to reduced demand and tighter lending standards. Balances are increasing for auto loans and mortgages, while new credit originations are down, Fahey noted. Sustained inflation for car and house prices is driving higher balances in these credit categories. This observation underscores the impact of rising costs on consumer finances, especially for big-ticket items like homes and vehicles. The report also highlights a drop in the average VantageScore 4.0 credit score, which fell by 1 point to 701. This decline reflects a growing difficulty for consumers in maintaining their payment schedules. The subprime tier of VantageScore has grown by 0.6 points, from 18.1% to 18.7%. Between July 2023 and July 2025. Conversely, the prime tier has shrunk by 1.4% over the same period. Earlier this month, the Federal Reserve Bank of New York's Center for Microeconomic Data released its quarterly report on household debt and credit. The report revealed that America's total household debt increased by $185 billion in the second quarter, reaching a total of $18.3 trillion. Mortgage balances alone grew by $131 billion, totaling $12.94 trillion by the end of the quarter. Auto loan balances rose by $13 billion from the first quarter, ending June at $1.66 trillion. Credit card debt, household expenses, and student loans comprised the majority of the nation's outstanding debt. At the end of July, the Mortgage Bankers Association reported that the national median mortgage payment was $2,172 in June, a slight decrease of $39 from May. For FHA loans, the national median mortgage payment was $1,881 in June, down from $1,927 in May. Idaho, Nevada, Arizona, Rhode Island, and Utah topped the list for mortgage applications, while Louisiana, the District of Columbia, Connecticut, West Virginia, and Alaska saw the fewest applications. A June report by LendingTree further detailed the state of auto loans. The average monthly payment for new cars was $745 at the end of the first quarter, representing a 1.1% increase from the same period in 2024. Americans borrowed $165.6 billion in new car loans during the first quarter of 2025, and the average loan term for new cars has extended to 68.6 months, with used cars averaging 67.2 months. What do you think about the rising delinquencies among top-tier consumers? Is this a sign of deeper economic troubles or just a temporary adjustment? Share your thoughts in the comments.